All right, so this video is going to be fairly short. Basically, for the rest of these videos, or for a large portion of them, we're going to be working through like special issues or special aspects of revenue recognition. So rather than just the core ideas, now we're going to kind of get into a few details that are, I think, common that you might see in practice, or just as you're going through your professional life, just situations where you might wonder, what is the appropriate way to handle this situation in terms of revenue recognition. And so each of these special issues is not meant to be comprehensive. It's not meant to be a situation where, oh, well, this is the only thing you're ever going to come across. But we're trying to kind of say, okay, here's some core ideas or core challenges that you might have in terms of understanding how to recognize revenue. This first one's going to be very short because we're only going to be really talking about certain issues under the first two steps, identifying the contract and identifying performance obligations. And then the last three, we'll probably do each of those, not all those separately, but there's definitely going to be like a longer process involved with the last three. And then at the very end, we're going to do a long-term construction contract. And so let's kind of jump right into it. So when we talk about identifying the contract, in general, we know that a contract is an agreement between two parties with enforceable rights. And so, hopefully that's kind of a given in some regards that, yeah, there's enforceable rights or obligations between two or more parties. And that kind of is what constitutes a contract. But what I want to, a couple things that kind of I think can be complicated. One is under US GAAP, a contract can be written, oral, or implied. In other words, you do not have to have a written contract under US GAAP in order to have a contract. Now, the standard sort of reads where it's preferred that the contract would be spelled out, but there's a lot of buyer-seller relationships where there's no formal contract. I mean, every time you go to a store and buy something, there really is an implicit contract that you as a customer have with that retailer. But obviously you don't sign anything. And so all of that to say, it does not have to be written. It can be written, oral, or implied. A couple of things with for us to make sure there is a contract. So first of all, for there to be a contract in US GAAP, the contract has to include things of commercial substance. And so, just think like there's got to be a real economic activity underlying the business relationship. And so if it doesn't have that economic commercial substance, you really don't have a contract in terms of the way US GAAP views contracts. The second thing is for there to be a contract under US GAAP, both parties have to approve the contract. And again, it could be like a signature, it could be like an implicit by actions. There should, like as an example, again, as a customer, if I go buy something at a store, I'm approving the contract when I give you a payment and you give me something in return. And so in that case, I've implicitly approved the contract. But you should be aware, though, that it doesn't always have to be, it can be implicit. It does not have to be an explicit approval. Another one is the contract. There does need to be the ability to identify rights of the parties. So obviously a lot of business to business formal contracts, they're going to spell out, let's say that someone's doing a consulting, some sort of consulting for a company. They're going to, I don't know, do like they're going to give them a valuation of their business or something like that. Let's say they're going to help them sell their business, something like that. Well, anyways, what you have to do, in other words, for the identification of rights, there has to be something that spells out, okay, the seller of the service, in this case, they're going to do this. It's going to spell out what they will do under the terms of the contract. But at the same time, a lot of times the buyer is going to have things that they're going to have to do. I'm sorry, the person who's going to use the services also has things they have to do, and sometimes those will be spelled out. And so those rights need to be established. Again, it can be explicit, oral, or implied, but there needs to be at least some idea of, here are the rights of the seller, here are the rights of the buyer. There needs to be payment terms. So there has to be something that suggests, okay, here is the economic flow that's going to be part of this transaction. And so, whether it's, hey, you'll pay me X on this date, X on this date, or it could be, okay, you're going to give me X% of every sale you make in the next whatever. And so it doesn't have to be a fixed amount, but the payment terms do need to be identified. So there needs to be something where they can point to, here are the economic consequences, the real economic consequences of this business relationship. And then finally, for there to be a contract, it must be probable that consideration will be collected. And so I don't know, let's say for some reason, we're you're going to pay me based on your lottery winnings next year. Well, okay, it's like, okay, if you hit the jackpot, you're going to give me 5% of your jackpot. Well, okay, it's not probable you're going to collect that. And so this is kind of a weird one, but we want it in place because sometimes you could write a contract to wiggle your way around the rules, and you could make the terms so ambiguous or so far-fetched that in reality, it may look like there's something of commercial substance, but because the probability of payment is so low, you really don't have anything of commercial substance. And so, you could have a situation where, let's say that I'm a little bit behind on my sales this year. And so I write a contract with a third party that says, okay, you're gonna buy these, or I'm gonna do something with this, but the probability of that event occurring is so remote that you're really never going to get paid, because the transaction is really never going to take place. And again, it's just sort of a way of getting around situations where someone might try to create a contract in order to accelerate revenue recognition or to kind of falsify revenue recognition. And this is sort of trying to make sure that they're not getting around the rules. And so that ends up playing a role, I think, more for like people who are trying to be nefarious versus like the day-to-day types of things that you might see. All right. One thing too to kind of keep in mind with the contract is under US GAAP, really the contract really starts to take economic substance once somebody performs. And so when we really kind of think about that is we could have a contract, but if no one's really done anything for US GAAP, we haven't started the process of operating under that contract. And so there's no asset or no liability. Therefore, really the contract in terms of accounting doesn't really exist quite yet, as far as where there's the potential to recognize revenue. Because of those other steps that are involved in the process, really until we start having some activity under the contract, you're never going to be recognizing revenue. And so again, so the contract in terms of what we're going to see on a journal entry or on financial statements, I want you to understand a contract alone does not allow us to recognize revenue. A contract must be in place in order for us to recognize revenue, but it doesn't cause it. And so there must be some performance underneath it, which is really what we're going to be getting to in the next steps. There can be changes to a contract. And so anytime there's a change to a contract, there could either be a new contract or there could be a modification of an existing contract. And I don't really want to get caught up in what distinguishes between the two, but if you could imagine, I may have a contract, I'm changing it, but it's the contract still there, or this new activity could almost be treated over here separately, where we have this contract and then we have a separate contract over here. You might not think it matters, but it really does. It matters in terms of timing. So if I have one contract, then all the performance obligations within that contract, especially if you have to wait till the end, you might have to wait to recognize revenue for all of it. Whereas if you think about two separate contracts, this one could sort of stand alone, be executed independently of this one. And so because of that, you could have a timing difference in revenue recognition, but I want to be clear, it will not change the amount. It just might change the timing of what you recognize. Okay, just some specific issues when it comes to performance obligations. Just again, this is more of a laundry list of, hey, you're going to come across this. Let's think through it clearly. And so what is it that, what is a separate performance obligation and what isn't? And one complication sometimes can be if there's a prepayment. As an example, if you join a gym, you got to pay $99 to join the gym, and then you have a monthly whatever after that, or there might be an application fee, or there's all these different things, or like a catering service, there may be like a non-refundable deposit or something like that. So what we're talking about is anytime before the service or good is service takes place or the good is exchanged, the buyer makes a prepayment towards that contract. And so it's very to be very clear, what I've highlighted here is that prepayment by itself is not a promise to transfer goods or services to the customer. So the prepayment is not a separate performance obligation. It's inherent to the actual performance obligation. So in other words, if I make a deposit with a caterer for a party I'm going to do in June, well, the reason I'm giving you the deposit is for the party, not for the sake of giving you a deposit. So in other words, you couldn't keep my money and not do the party, if that makes any kind of sense. And so it would not be a separate performance obligation. So basically what happens is that prepaid amount, it gets rolled into the overall transaction price. And as each obligation, however it's assigned, is complete, that is when you would recognize that revenue. So just to be clear, when there's a prepayment and a deposit, even if it's non-refundable, is a common example of this. A prepayment is not a separate performance obligation, and so the payment itself would not cause revenue to be recognized. Again, it's deferred revenue until that point in time. Another one is warranties. There are really two types of warranties. There are assurance type warranties and service type warranties. An assurance type warranty is basically if there's a defect, we're gonna replace it or fix it. And if it's an assurance type warranty, sort of like the default warranty when you buy a refrigerator at Lowe's or something like that. Basically, it's like, hey, listen, if the compressor's out or something's not working on it, we're going to fix it or we'll give you a new one. That is not a separate performance obligation, because the whole idea there is I bought the refrigerator to have an operating refrigerator. I didn't buy the refrigerator in order to fix it in the next month. And so those are sort of given assurance type warranties, they're not considered as a separate performance obligation. However, a service type warranty is. And so a service type warranty basically says, hey, listen, we will cover it, or we will give you a discount or whatever it might be. We're going to warranty basically damage or breakage that happens as part of your normal usage. So in other words, it's not like there was something wrong in the manufacturing process. It's just, hey, you started using it and something broke, we'll fix it. Now, again, when you bought the refrigerator, the expectation that you're going to fix the refrigerator from my normal usage is not assumed. And so because it's sort of this distinct, what's the right word, benefit that the buyer is going to have, it would be treated as a separate performance obligation within the contract. And a lot of times, this is why companies like Lowe's will separately price out the service type warranty. They'll say, hey, we have a assurance type warranty that comes with the sale. If you want, a service type warranty, it's another $120 or whatever it might be. And then you can make it the distinction. And what they've done there is they've priced the two independently. They've said, okay, the sale is worth $800 or $1,500, whatever you paid for your refrigerator. And then the warranty is $120. And really, again, the importance there is at the time of the sale, I can recognize the revenue with the refrigerator. But the service type warranty, I have to recognize that as a seller from Lowe's, I have to recognize that warranty as I'm providing the service. And so it gets deferred. And so the timing mechanism is really important, which is why GAAP requires they be separated. A couple other things here. There are customer options for additional goods and services. So you may make a sale and there may be some additional service or something that you're going to offer for free or for a discounted price. As an example, whenever you buy, if you go to Best Buy and you buy like a computer, they allow you to join Geek Squad or whatever that is for a discount. And so, and if you don't buy it, it's maybe, I don't know, like let's say if you don't buy something from Best Buy, it's to be part of their club, it's $200. But if you buy something where, then it's $99 or something like that. So that option that I have because I purchased a good or item, that is now a separate performance obligation. Again, if those options are material right, then again, you have this other performance obligation under the contract. And so, again, it's one of those things too, or they might even say, okay, listen, we'll let you be part of Geek Squad for 1 year for free, something like that. And so what it means though, is there's a portion of that purchase price that needs to be allocated to that additional performance obligation because that's a material right, either the discount or for free. is not something that the buyer would otherwise have. And so if I'm Best Buy and I give Geek Squad service for 1 year, well, at that point in time, that Geek Squad service is a separate performance obligation, and I have to allocate a portion of the sales price to that Geek Squad service. All right, so we'll stop there. Again, I wanted to keep this one somewhat brief. The next ones might be a little bit longer, but again, in class, we tend to go down a lot more rabbit trails, and I'm sure you're going to ask a lot of questions, but hopefully this highlights some of the things that we talked about and gives you a better idea of how to handle some of these unique situations.